Good morning. What happens when people need a $400 for an emergency and they're being offering a quick loan that would end up costing them $1,000? This situation is a reality for many low income families. When savings are thin and options are limited, these situations, this type of loans are very attractive and sometimes they can become a lifeline. From working in the banking industry and recently moving to the lending side, I witnessed how installments and high payday loans can become vicious cycles for consumers that can barely afford them. And predatory lending, that's the name. The name that targets the vulnerability and lack of knowledge from borrowers in need. However, with protective regulations and accessible financial education, the cycle can be broken. And today, I'll be covering how predatory loans lead to long term cycles, why low income populations are the most exposed, what possible solutions do we have today? Well, to begin, let's talk about the debt cycle itself. In 2025, St. Mary's Law Journal highlighted the impact of how vulnerability is monetized by lenders with small, fast loans that can come along with high interest rate, especially after economic shocks or disasters. But how? These short-term loans like payday or title options are promoted as quick solutions without fully acknowledging an average of 300% APR. For example, if you borrow $100 and the lender charges you 100 over the course of 14 days, this equals to an annual percentage rate of 338. However, $13 sounds like nothing compared to the ability to have a quick 100, right? But due to the repayment periods being so short and most of the amounts are greater than $100, most borrowers will have to return to that financial institution to get a new loan to cover previous ones, starting slow and creating a vicious cycle. These situations can lead to financial stress on family, leading to unstable household budgets, and the debt that outlives the original debt. The cycle is very simple: small loans, small windows, excessive cost, and repeat. Once identified the cycle, now whose exposure? The Consumer Financial Law have reported that caps in fair lending have created environments where high cost lenders have grown way faster than any other safer institutions like banks and credit unions. Communities with low income have been targeted as a high risk profiles due to the lack of access and alternatives to fair lending options. For a quick reference, in a low income zip code area, you might see one bank branch per 7,500 residents compared to one per 2,500 residents in a middle income area. As well, financial institutions decides what their lending guidelines are to the different markets, but what happens when they don't extend their credit building tools, like secure credit cards, or traditional loans to consumer? What happens? They're pushed to apply to get denied by these banks, and then to go obtain a predatory loan with a high interest rate from a different lender. Even though on paper these consumers look risky, the reality is that they have taller walls than other communities. Things like unstable work environments, limited financial guidance, and transportation make things harder to work with financial institutions to obtain fair loans. So, if we have limited options, what can we do? Well, John Hope Bryan, in a 2024 article, makes the argument that financial literacy, when offered without cost to community, makes spectacular results in reduction of economic struggles, a better understanding of financial, and this leads to protect communities. Promoting high school programs prepares younger generations to understand basic financial finance and gives them the critical thinking when it comes to making financial decisions. An example: many people have this wrong idea when someone says they're getting a loan for $10,000 with a 20% APR. Many would think I would only pay $2,000 in interest, but that's not the reality. You would end up paying $8,000, almost twice the amount you got. More also, by obtaining more regional banks, this could give them affordable lending, so payday loans are not their default option. As well, compliance paired up with strong regulations that offer competitive loans to those in low income can make a huge difference. This is why when family members or friends can never end their debt suffering, even though they pay their initial loans over and over. Okay, so today we learned what's the debt cycle, how low communities are exposed to predatory lending, and how free education and regulations make a difference. The goal is not to ban borrowing, is to make it safe and affordable for anyone, and help should not cost more than harm hurts. In a better future, low-income communities have access to lending resource and a full understanding of financial disclosure. Well, that's all for me today. Hope you all enjoy.